Hello and welcome to another edition of Penny Stock Analysis and PennyStockAnalysis.com. Today's video stock session is about the moving averages. These are very commonly used tools. They've been used for a while and are kind of like a toothbrush, tried, tested, and true. So we're going to continue our analysis here. The definition of a moving average, a little bit about how it's made and how you can use them to analyze your stocks. One of the great things about a moving average is that it can be used to see an underlying trend, and it can do this by smoothing out the price over a given period of time. In other words, your price at point A may be $10, your price at point B may be $20, but in between, that price may have fluctuated up to $30 and down to $5. So that moving average is really useful in making a trend out of seemingly unrelated points. Also, it's usually a lagging indicator, and I stress the usually part because it depends on how small of a measurement of days that you use for the moving average, and it's very useful for confirming a trend. Also, the great thing about a moving average, it can be changed for any number of reasons. Maybe you're a day trader and you want the moving average for 10 minutes time, or if you're a very long trader, maybe use a 200-day moving average. So it really all comes down to you and the type of investor you are. If you have been following the penny stock analysis educational videos, which of course you can find on our YouTube channel under the Nomer penny stock analysis, then you will have noticed that a lot of our indicators are what's considered lower level indicators. This, the moving average, is an upper level indicator. In other words, it's plotted against the price chart. A couple of other things you should note is that moving averages typically provide more insight when it's used against many different time frames. So for instance, a 10-day, a 20-day, and a 50-day moving average. In other words, you start with a short trend. Does it go higher than the medium trend? And is there an upward trend over 50 days, which means it's a very long-term rising trend or downward trend? And also, one of the key things you want to look for in a moving average are when there are crossovers. Usually when short-term trends cross over long-term trends, it's positive, and when they cross below, it's usually considered a bearish sign. So once you delve into technical analysis with much more rigor, you'll notice that moving averages come in many different shapes and forms, but in two broad strokes we have the simple moving average and exponential moving averages. In general, over the long term, the simple and exponential moving averages don't show much difference. However, when you're looking at shorter time frames, the exponential moving average tends to move more quickly and in line with the price because of the way it's calculated. In other words, in an exponential moving average, the recent day's price holds more weight than, let's say, the last day's price recorded. And with a simple moving average, all prices over the same time period are weighted the same, which is why there's typically more lag in its ability to identify a trend or crossover. All the things you should be looking for in trend reversal. So we're not going to delve too much more on that, but it's an important difference to understand and one we will briefly touch upon later in the presentation.